Okay, guys, welcome to another class. This is chapter 2. This is where the material really, this is critical here. So make sure you can do these practice problems that I'm going to show you on this slide. Make sure this stuff makes sense because the whole rest of the semester hinges on this material here. Like, this is the foundational material. This is where the rubber meets the road. And really, this is like your test. The vast majority of the test questions are going to relate to this material. Okay, so the slide that I'm using is not the chapter 2 one. It's actually called, what is it called? I think it's chapter 2 examples. Okay, so chapter 2 examples is the PowerPoint. You can look at just the normal chapter 2 and go through it. It has good information in it, but I like using this one better because we just get into examples right away. And the best way to learn this material is to just do a lot of examples. Okay, and don't do them when you're looking at the answer, because that'll give you a false sense of security. You'll feel like, oh yeah, I understand this, but then like when you don't have the answer right there with you, then you'll get confused, or you'll think like, oh, was it this or was it that? So anyway, hopefully this will make sense. I'll do kind of a short video, and then another video, kind of break it up into pieces. Okay, so this is where we really like record transactions, and that's a point of financial accounting, is recording transactions. Okay, like the economic activity of the business. Okay, so that's the whole point of an accounting system, is to identify economic events and then express them, like record them. Okay, and an economic event is simply something that directly affects the financial position of the company. Remember, we capture economic events through the accounting equation, right? And so we look at this next slide. And we kind of already talked through this. So we have our assets. That's the resources of the business. The liabilities, that is what we have due to others, or what we owe others. And then the owner's equity, or the equity of the company, is simply what is left over. Now, any event or any transaction, it's going to impact two parts of this equation, right? It has to, in order to get the equation to continue to balance. Like our assets, right here, if our assets go up by 100, it's a little delayed there. If the assets go up by 100, that equation doesn't balance, right? Because this would be 100, liabilities would be 0, equity would be 0. So something else had to have changed. Okay, so your assets can go up by 100, and in the same sense, they can also go down by 100. Okay, so let's say our cash goes up, but our accounts receivable go down. So then this balances, right? Because these offset each other. Okay. Or your assets could go up by 100 and your liabilities could go up by 100, right? Which that still balances. So that's if we borrowed money from the bank or something, then our cash is going up, but our liabilities are also going up because we owe that money to the bank. Or the other thing that could happen, and I mean, lots can happen, I'm just kind of giving you some examples. So the other thing that could happen is your assets could go up, but your owner's equity could also go up by 100. Okay, and that means that the owners of the business put $100 into the business, so their equity went up in the business. Okay, so those are all examples of how this equation, you can't have something just happen to one of these elements and not the others. Or if it happens to the same element, then it has to go up and down. Okay, so just know that like every transaction is going to have a dual impact. It's going to impact this accounting equation in two different ways. Okay. I think I showed you already, but just in case I didn't, erase all this stuff. This owner's equity, really important account. Okay, and it ends up kind of complicating it just a little bit more, right? Like assets, most of the time students are pretty good with assets. It's like the resources of the business. Liability is pretty good with that. Like, hey, that's what we owe to other people. Students are typically pretty good with this. But owner's equity, I think I did explain this, but remember, there are actually two ways to increase owner's equity. Okay, so the two ways to increase it would be revenue and also common. Okay. So think about revenue is, don't think of that as money. Okay. Instead, like if received cash over here, that's an asset, that's money. Okay. So that goes up by 100. What this revenue account is doing is it is showing like how we received the cash. So it's explaining why our assets went up. So our revenue, one way for owner's equity to go up would be increasing cash by 100. Okay. Common stock I actually just showed you, like that's if the owners contribute money into the business. Okay. And then two ways for owner's equity to go down. And these are the only, so this is like all you have to memorize. You have to memorize assets, liabilities, owner's equity, and know that it's divided into 4 categories. So revenue, common stock, that increases owner's equity. And then what decreases it are expenses and dividends. Okay, so our expenses are incurred in the operations of the business, the day-to-day. If we buy fuel for our vehicle, or if we have to pay someone to mow the lawn in front of the business, those are expenses. And then dividends are when we distribute money back to the owners. So if you think about that, like let's say that our assets go down by 100. Okay, so why would our assets go down? Well, we could have incurred an expense, and so that would be 100 over here. And do you see how that's causing owner's equity to go down? So the equation still balances. Or we could have paid out dividends, right? So we could have paid money back to the owners, and that would have our dividends go down. Okay, which I mean would cause our owner's equity to go down. So really, it's increasing our dividends, which causes our owner's equity to go down. Okay, so like I said, the key to this is knowing how transactions impact these things here. So how it impacts assets, how it impacts liabilities, how it impacts owner's equity, which is composed of 4 things. And if you will really spend some time thinking about this and getting this down, life will be so much better for you. Okay, so let's go look at an example. Let's see here. We got to turn this on to. There. Go figure. On this iPad, it's not formatted very good. That's all right. I'll just get rid of it. And you can do this too on the test. You can abbreviate all this, okay? So an attorney invested $50,000 to open a law office. Okay, so this attorney is creating a business. Okay, so what we are interested in, assets equals liabilities plus equity. Okay, and this is all you have to do. This is all you have to write down, like on the test too, is to show like how does this impact the economic entity of the business. Remember, the business is separate from the attorney. Okay, so the business is receiving $50,000, right? So the assets of the business are going up. Cash is an asset, right? It's a resource of the business. Okay, now are the liabilities going up? Does the business have to pay back that $50,000 to the owner, to the attorney who started it? No. Remember, one of the rules of equity financing is technically it doesn't have to be paid back, right? So if the business, which is really just this attorney, but if he blew the money, if he spent it all on advertising, the $50,000 was gone, and then he decided to go work for someone else, then at that point, there would be no equity left. And so it wouldn't go back to the owner. Okay. But this, this transaction here is this specific thing. The assets of the business are going up. The cash is going up, right? And this is all in dollars, right? The liabilities aren't going up because it isn't owed to the, isn't owed to the owner. Okay. But the equity of the business is going up. Remember, common stock is one of the ways the equity goes up. Okay. And so now the owner owns $50,000 of common stock in the business. Okay. And so you see how this still balances. The assets are going up by 50,000 and the equity is going up by 50,000. Okay. Okay. Let's look at this one. Now we're borrowing money from the bank. Okay. And so again, we're receiving cash, the businesses. Okay. So when I say we, I'm talking about the business. So if we go again, assets equals liabilities plus equity. Okay. The assets are going up $40,000 because the business received that $40,000 of cash. Okay. In this case, though, we are obligated to pay it back to the bank. We owe it to the bank. So it's a future obligation, which is the definition of liability. So our liabilities are also going up by $40,000. Okay. Do you see how the equation is still balancing? Over on this side of the equation, this side here, the left side, it still equals the right side of the equation. Therefore, we know that it's right, or at least we have an indication that it's right. Okay, so that's that next one. Okay, next one. We purchase supplies on account. Okay, so we've went out, we've bought, I don't know, supplies, right? So think of buying like paper or I don't know, I'm just saying like office supplies. Obviously, it's a lot of office supplies, $3,000 worth of office supplies. Okay, so think about that. Office supplies, do they have future value to the business? They do, right? Like we're going to be able to consume those supplies going into the future. Okay, so that means our assets are going up. See, sometimes people would think like, oh, for spending money, that's an expense, but not so, not in accrual basis accounting. Okay, in accrual basis accounting, we want to understand how the economic entity is impacted. So if we're buying supplies, okay, then those supplies are going to have future value. So that meets the definition of an asset. They're resources to a business, right? So our assets are going up by $3,000. Okay, that's super critical. Okay, that you understand that our assets are going up. Not, this is not an expense. Okay. Now it says we did this on account. That means we didn't actually pay for them with cash. If we would have paid for them with cash, then our assets would have went up, but then our assets also would have went down, right? Because our cash would have went out the door, $3,000. But in this case, because it's on account, which, sorry, that I don't like how it's formatted on this iPad. But anyways, it says on account. You can see it back behind there. So that means that our liabilities, we have a future obligation, and those are also going up. So you can see that the equation still balances, okay? And there is no expense. The expense would actually occur at a later date when we consume the supplies or when we use up the supplies, okay? Oops. Let's get there. There we go. Okay, so services were performed on account for $10,000. Okay, so here we're doing work, right? And remember, I told you that revenue is that idea of doing work in accrual basis accounting. That's how we think of revenue. Okay, so we have assets equals liabilities plus equity. And what I want you to do is go through and practice doing these problems without looking at the answers. Okay, so try to do them without, kind of how I'm doing them right now. I'm not looking at the answer. I'm trying to just think through it and make sure I understand it. Okay, so we did work. Remember, that is revenue, and revenue is one of the two ways that equity is increased. Okay, so this is 10,000. So we did $10,000 worth of work. Okay, what's interesting though is we did it on account. Okay, so we did not receive a check from the customer right this minute, or they didn't give us cash. They actually told us like, hey, we'll pay you 10 days from now, 20 days from now, a month from now, or something. Okay. So we're not receiving cash, but we are receiving a different type of asset, a different type of resource, and that would be accounts receivable. Okay. So our assets are going up, accounts receivable, $10,000. Okay. And our revenue, which is our equity, is one of the equity accounts, is going up also. And so do you see how the equation balances? Okay. So on the test for this part, you would just, I would give you points if you just showed an up arrow 10,000 for assets, an up arrow 10,000 for equity. Ideally, you'd be able to identify that this is accounts receivable. So you'd write down accounts receivable and write down revenue and show that they're going up. Baby steps, right? So here it's saying service revenue. I'm fine with just abbreviating and saying okay. Salaries. Okay, so now we've hired some people or a person and they've worked for us. Okay, so we're going to pay them money. Okay, see it says $5,000 were paid to employees. So not $5,000 was owed to employees, but $5,000 were paid. Okay, so we paid them a resource, we paid them cash, right? So our assets are going down $5,000. Okay, and in this case, this is an expense. We've incurred this in the normal course of the business. Remember, expenses are one of the two ways that equity goes down. Okay, so expense, $5,000. Okay. So our equity is going down. Our expenses are actually going up. But remember, expenses and dividends cause equity to go down. Okay, so our assets are going down, our cash went out the door, and then the expense account is kind of explaining why our cash went down. Okay, that's one way to think about it. Okay, supplies. Remember, we bought supplies earlier, and that showed our assets going up. And then now in this one, it's saying supplies were used. Okay, so one thing that students struggle with is they start thinking ahead too much. Okay, they start to worry about, well, what happened next? We'll be really careful with doing that. Just focus on the exact words of what it's saying in this very moment, and then make the adjustments or record how it impacts the accounting equation based on this very second. Okay, so this very second, our supplies are going down by 500, right? Those are the resources of the business, so that's our supplies. Okay? It's a type of asset. And then what explains why our assets are going down is our equity is going down. And this is another example of an expense. Okay, so we're using up the resources of the business, and so we record that as an expense. Okay, the expense is explaining why our assets are going down. Okay, $1,000 was paid on account to supply vendor. Okay, remember before we purchased these supplies, but we purchased them on account, right? So we didn't pay for them. What we need to do is now we're going to pay for some of the supplies, only $1,000 worth, right? And so we're paying out cash. So our assets are going down, right? Cash is going down by $1,000. Okay. And then remember before when we purchased on account, our liabilities went up. Well, now that we've paid some of that off, our liabilities are going down. We don't owe this money anymore. Okay. And so the liability account that's going down in particular is accounts payable. A payable is what we owe. A receivable is what is owed to us. Okay. So accounts payable are going down and our cash is going down. We've paid off part of that liability, $1,000 worth of that, right? Okay, cool. The next video we'll get into debits and credits, but make sure you understand and can fundamentally do these types of problems and just try to find as many problems as you can to map out how it impacts the accounting equation. I appreciate you guys watching.